I'm going to ask my last question, which is how do we get some of these reforms? How do we get public discussion? But before I do, are there questions from the audience as we get to wrapping up for this extraordinary group that we have here? Yes, go ahead. Could you please identify yourself as you ask the question?
I'm Larson. I'm a member of the community. I'm a sociologist. But I'm sorry if my perplexity seems ignorant, but you are talking about the danger of low interest rates. At the same time, I wanted to ask you what happens if what to me the biggest issue right now, which is unemployment and permanent stagnant employment for millions of people, which is in fact, there is some agreement has been driven by cutting the deficit in a time of recession. So I would like you to explain very simply for me what raising the interest rate would do to what is still a pretty stagnant economy. Because if capital becomes more expensive, there would be even less investment in them, even less hiring or not.
Does anyone want to take that on?
Well, I think the point Sheila was making was that there's been very little evidence that this huge quantitative easing has done much except for distort markets. These low interest rates are really not being passed on to new buyers of homes. They're not being passed on to people who want to buy new cars. It's a policy that is not delivering what we really care about, which is the unemployed.
Why are mortgage rates so low then?
They're not so low.
They're not so low.
You think unemployment rates are low?
No,
mortgage rates.
Oh, mortgage rates are low. Well,
you can't get them is the problem.
Yeah, you can't, right. So very creditworthy borrowers can get them. But I think that's, I would be, if I thought it was increasing employment seeing real wage growth, I would say let's take the risk, but it's not. And actually it's making income and wealth inequality worse because the primary impact of it is to inflate bond and stock values. So the bond market has gone up. As yields go down, the bond prices go up, right? There's an inverse relationship. And as bonds provide lower yields, investments are reallocated in the stock market, which has pushed the stock market up. So upper income people disproportionately own most of the financial assets in this country. So if you own stocks and bonds, you've gotten some benefit from that. But that's not most Americans. And so it's made it worse, and it has undermined our savings culture. People should be delevering after this. We live in an economy that has cycles. Hopefully nothing like we just went through, but it has cycles. People need a reservoir of saving, or just for their own personal needs. They shouldn't be given incentives to pull their money out of savings or go borrow and spend, but that is exactly what's going on. Because the yields you're getting on your bank deposit or your treasury security is not keeping pace with inflation. So you go to a riskier asset, or you go out and spend the money.
And it's interesting, if you go back to the original rationale for the whole QE exercise, it was to work on the wealth effect.
Yeah.
Because they thought if they could drive up stock prices, people would spend more. And there is some econometric evidence
rich
that
people.
do it, but that's the rich people spending
So,
more.
and lower income people spend more of their disposable income. So they spend their money. Rich people just save it and invest it some more in wherever's, more in financial assets, which keeps them going. So. The income inequality, and this has real ramifications for what drives the economy. And ultimately, I think it's self-defeating because the middle income and lower income people, we need to get real wage growth. You want to get this economy going, we need to get more jobs and real wage growth. We don't have it now. We've got financial asset inflation that primarily benefits the upper classes. And I think what you just articulated is the argument that they use. And like I said, if I saw that was really happening, fine, but that's not what's happening. Something very different is happening.
I think if you look at Japan, it's a very interesting case because they've had low interest rates for over a decade now. And it's
2 decades.
Two decades, right.
The lost decades.
And it just hasn't worked. And it's not just these effects that Sheila and Dick are talking about, but what seems to happen is that companies become much less competitive. So Japan had the most competitive companies in the world 20 years ago. Now they can't compete at all. And so they're major companies like Panasonic and Sharp and things are facing bankruptcy, and
Korea's the new high-tech center.
yeah, and Korea
That's
has
right.
managed to overtake them all. And I think these low interest rates have lots of very bad effects, and we need to announce a slow raising of them over time so that we don't have this big drop in capital values.